COSCO Capital Incorporated is a Philippine investment holding company with core interests in consumer-focused businesses. It began in 1988 as Alcorn Petroleum and Minerals, an oil and mining firm, but later reinvented itself as a retail-focused conglomerate. In 2000, under the leadership of businessman Lucio Co., the company shifted its strategy from resource exploration to retail holdings and was renamed COSCO Capital Incorporated. This transformation entailed consolidating Mr. Co.'s various enterprises, spanning grocery stores, wholesale distribution, real estate, and others, under one corporate umbrella. Today, COSCO Capital is known as one of the fastest-growing retail holding companies in the Philippines, leveraging a diverse portfolio of consumer-driven businesses. As a holding company, COSCO Capital's business model centers on owning and managing controlling stakes in its subsidiaries across different sectors. Rather than selling a single product or service, COSCO operates as a parent company that generates value by overseeing a synergistic mix of businesses. Its mission is to enrich Filipino lives by providing quality, affordable products and services, and it pursues this by investing in industries that cater to everyday consumer needs. The corporate structure enables COSCO to share resources and capital among its subsidiaries, while benefiting from steady cash flows of mature businesses, like supermarkets, to fund growth in emerging ventures, such as specialty retail. Overall, COSCO's strategy is to capture opportunities in retail and related sectors, building a resilient conglomerate that thrives on Filipino consumers' essential spending. COSCO Capital's operations span several key segments, each addressing a different aspect of the consumer market. Grocery retail is the flagship segment, comprising Pure Gold Price Club Incorporated and SNR membership shopping. Pure Gold, founded in 1998, is one of the country's largest supermarket chains, serving a broad customer base with over 450 stores nationwide as of 2022. It operates various formats, from large hypermarkets to smaller neighborhood groceries, targeting both retail shoppers and resellers. SNR, acquired by COSCO in 2013 via Carrila Management Corporation, is a warehouse club modeled after U.S. wholesale clubs, offering a membership-based shopping experience. With around 22 warehouse stores nationally, SNR caters to middle and upper-income consumers seeking imported goods and bulk discounts. Together, Pure Gold and SNR solidify COSCO's strong presence in food retail, covering Filipino shoppers from low-income, tingy buyers up to bulk buying customers. Notably, COSCO owns roughly half of Pure Gold and SNR's parent entities, giving it controlling influence in this segment. The grocery retail segment is COSCO's largest income contributor, accounting for about 63% of core net income in 2022 and remains the cornerstone of its business model. The next major segment is wine and liquor distribution. Handled through COSCO's subsidiary The Keepers Holdings Incorporated, COSCO folded its long-held liquor companies, Montasco, Meritus Prime, and Premier Wine and Spirits, into The Keepers, which is now the largest importer and distributor of alcoholic beverages in the Philippines. The Keepers holds exclusive Philippine distributorships for leading global brands. For example, it markets Alfonso brandy, the top imported brandy locally, alongside various wines, whiskeys, and specialty beverages. By 2020, COSCO's liquor group commanded an estimated 74% share of the imported spirits market by volume. This segment contributed about 25% of COSCO's net income in 2022, reflecting its high margins and growth. The liquor business has been expanding through portfolio diversification and acquisitions. In 2022, The Keepers acquired 50% of Bodegas Williams and Humbert, the Spanish producer of Alfonso brandy, securing its supply chain for a key product. Overall, COSCO's liquor distribution arm is a significant growth engine, benefiting from Filipinos' steady demand for spirits and the company's dominant market position. COSCO Capital also operates a commercial real estate and property leasing segment. Through subsidiaries like Elimac Prime Holdings Incorporated and Fortuna Holdings, COSCO owns a portfolio of retail complexes, commercial centers, and land holdings. As of 2022, Ellimac Prime, Costco's flagship property unit, had 55 properties, including 32 operating commercial retail buildings, such as community malls and store sites, 9 properties under long-term land leases, and 14 more in development. These properties often house pure gold supermarkets, S&R warehouses, or third-party tenants like pharmacies, restaurants, and banks, creating an integrated ecosystem for Costco's retail operations. The real estate segment contributed about 11% of Costco's net income in 2022. Its revenues come primarily from rental income, 1.81 billion Cuban pesos in 2022, up 7% as economic activity picked up. While a smaller piece of the pie, Costco's property holdings are strategic. They secure prime locations for pure gold/S and our stores and generate steady lease income, effectively making Costco both landlord and retailer. In addition, Costco has a specialty retail segment, mainly via its subsidiary Office Warehouse. Incorporated Office Warehouse is a retail chain focused on office supplies, school stationery, and related products. It operates dozens of outlets, 87 stores as of 2022, concentrated in Metro Manila and nearby regions. This business targets small and medium enterprises, schools, and consumers for affordable office solutions. Though it was hit by pandemic lockdowns since schools and offices closed, Office Warehouse remained resilient and returned to growth as the economy reopened. In 2022, the specialty retail segment accounted for a modest 1% of Costco's net income, 69 million pesos profit in 2022, up from 50 million pesos in 2021. Costco sees this segment as an adjacency to its core retail business. For example, Office Warehouse has store-within-a-store setups in some pure gold locations, and as a platform for exploring other niche retail ventures. A recent development is Costco's partnership with Siam Global House of Thailand to enter the home improvement retail space, which hints at further expansion of the specialty retail segment in the future. Lastly, Costco retains interests in oil and mineral exploration, which is a legacy of its pre-2000 history. The subsidiary Alcorn Petroleum and Minerals Corporation, the original corporation, remains part of the group, holding various exploration rights and assets. Costco's oil and mining segment, sometimes termed energy segment, includes what remains of its prior ventures. For example, storage facilities for liquefied petroleum gas, LPG, and a few minor exploration projects. However, this segment is relatively dormant after Costco divested major assets like liquid gas and LPG distributor, which was sold in 2019. In recent financial reports, the oil and mining division contributes virtually zero to income, grouped under others, or a small percentage. It is maintained likely for potential opportunities in energy that may arise, but for now, it's not a significant earnings driver. The core value of COSCO Capital truly lies in its retail, distribution, and real estate segments, which collectively form a diversified but consumer-centric business model. Summary of segments. In essence, COSCO Capital's portfolio can be viewed as 4 pillars: grocery retail, liquor distribution, commercial real estate, and specialty retail, plus a negligible legacy energy/mining arm. Grocery and liquor are the heavyweights, fueling the bulk of revenue and profit, nearly 90% of net income combined. Real estate and specialty retail provide supplementary income and strategic support to the main businesses. This multi-segment structure allows Costco to participate in various parts of the consumer spending chain, from daily essentials, food and beverage, to discretionary retail, office, and home goods. The segments are interlinked. For example, pure gold stores sit on Costco-owned land. Liquor products are sold in pure gold outlets, giving Costco a vertically integrated ecosystem in the Filipino consumer market. This structure has been deliberately cultivated by management to create multiple revenue streams and a degree of diversification, while still focusing on the single broad theme of retail and consumer demand. COSCO Capital's financial performance over the past several years reflects steady growth, resilience during economic downturns, and a strong post-pandemic rebound. Top-line revenue has trended upward consistently. In 2022, consolidated revenues reached 197.1 billion pesos, a 13% increase from 174.4 billion pesos in 2021. This growth was driven by recovering consumer demand across all segments as the Philippine economy reopened. By 2023, revenues climbed further to about 214.5 billion pesos, approximately up 8.8% year-on-year, indicating continued expansion despite high inflation that year. Over a 5-year horizon, COSCO's sales have grown at roughly a high single-digit annual pace, showcasing the robustness of its retail-centric portfolio even in challenging times. During the 2020 pandemic slump, sales dipped only modestly and were quick to recover, thanks to the essential nature of groceries and liquor, which buoyed demand. The compound annual growth rate of revenue has been estimated around 8 to 9% in recent years, underscoring a stable upward trajectory. Bottom line, net income has likewise shown an overall rising trend, with a notable surge after pandemic disruptions. In 2018, COSCO posted a net income of approximately 8.8 billion pesos, up 12% from the prior year, as its retail businesses expanded. By 2019, core earnings grew further, roughly in the 9 to 10 billion pesos range. Though reported net income was exceptionally high that year due to a one-time gain from selling the Liquigas LPG business. During 2020, the height of COVID-19 lockdowns, COSCO still managed to earn around 7 billion pesos net, a slight decline, demonstrating resilience as supermarkets and essential retail stayed open. Financial results then improved sharply. 2021 saw net income hit 10.5 billion pesos, about a 50% rebound from 2020's level, aided by economic reopening and pent-up consumer demand. In 2022, COSCO's earnings climbed further to a record 12.3 billion pesos, a 17.1% jump year-on-year. This robust 2022 result was attributed to better profit margins and strong sales recovery in all segments. The momentum paused in 2023 when net income came in at 12.4 billion pesos, virtually flat, up 1% compared to 2022. Higher operating costs and inflationary pressures squeezed margins in 2023, yielding only marginal profit growth, 12.4 billion versus 12.3 billion. Nonetheless, COSCO remained solidly profitable, and revenues continued to grow in 2023, setting the stage for the next uptick. Most recently, in 2024, COSCO delivered a strong earnings jump again. Consolidated net income for 2024 reached approximately 15.5 billion pesos, representing a 25% surge compared to the prior year. This significant rise reflects improved consumer spending post-pandemic, as well as strategic efforts like cost management and perhaps higher contributions from the liquor segment. All of COSCO's business units showed improved performance in 2024 amid the tailwind of economic recovery. It's worth noting that 2024's profit growth far outpaced revenue growth, implying margin expansion, possibly due to better sales mix, more high-margin liquor sales, and efficiencies. With 15.5 billion pesos in net earnings, 2024 stands as COSCO's best year on record. To put these figures in perspective, COSCO's net income has roughly doubled from the mid-7 billion pesos range in 2015 to 2016 to over 15 billion pesos in 2024, illustrating a clear long-term growth trend. From a segment perspective, Pure Gold and SNR have been the stalwarts, steadily growing sales and profits. For instance, in 2022, the retail segment's net income was 9.3 billion pesos, up 13% year-on-year, supported by a 12.3% rise in net sales to 184.3 billion pesos. Same-store sales growth of around 6% in 2022 showed strong recovery in foot traffic. The Keepers Holdings had an outstanding 2022, with net income up 41% to 2.23 billion pesos. As Filipinos celebrated the post-lockdown era, volumes sold grew 20%. Liquor's momentum continued into 2024, helping boost COSCO's consolidated earnings. Real estate saw a slight dip in 2022 profit, 845 million pesos versus 915 million pesos in 2021, due to rising utility costs, but it remained a stable contributor. Office warehouse and specialty retail swung back to growth in 2022 to 2023 after pandemic lows, albeit on a small base. Overall, COSCO's diversified segments have provided multiple income streams. When one segment faces headwinds, others, like liquor or grocery, often offset them. This balance was evident in 2020 and 2021. Grocery kept cash flowing during lockdowns, and later, liquor's rebound turbocharged 2022 to 2024 profits. In terms of key financial metrics, COSCO's profitability margins are modest but consistent. Net profit margin has hovered in the 3 to 4% range in recent years. 3.8% as of the latest 12 months, which is typical for a high-volume retail business. Operating margin in 2022 was around 8%, and gross margin about 19%, reflecting the relatively low markups in grocery retail, counterbalanced by higher margins in liquor distribution. Return on equity has averaged around 10% annually, indicating decent efficiency in generating profits from shareholders' capital. These figures improved in 2024 alongside the earnings jump. For example, basic earnings per share roughly doubled from 1.07 pesos in 2023 to about 2.20 pesos in 2024, based on preliminary reports. As net income rose and COSCO continued share buybacks. It's also notable that cash flows have been very robust. In the last full year reported, COSCO generated 28.9 billion pesos in operating cash flow and 22.3 billion pesos in free cash flow, substantially exceeding its accounting net income of around 9 to 12 billion pesos. This implies strong cash earnings, perhaps due to non-cash expenses and favorable working capital changes, and suggests that COSCO's businesses convert earnings to cash efficiently. Such strong free cash flow has enabled the company to fund dividends and share repurchases, while still investing in expansion. Overall, COSCO Capital's historical financial performance paints a picture of a steadily growing, consistently profitable conglomerate. It weathered the COVID-19 crisis with resilience and emerged with record earnings in its aftermath. Revenues and profits have expanded over the last 5 years, albeit with a plateau in 2023, followed by renewed growth in 2024. The company has managed to balance growth with stability, thanks to its mix of defensive, grocery, and high-margin liquor ventures. As of the latest year, COSCO is larger and earning more than ever, positioning it strongly for the future, provided it can sustain momentum and navigate competitive and cost challenges going forward. COSCO Capital stock price has experienced significant swings over the past 5 years, ultimately delivering solid gains to long-term holders. In the late 2010s, COSCO's share price traded in the mid-single digits in Philippine pesos, as the market viewed it as a stable but low-growth retail play. During the 2020 pandemic, the stock initially declined along with the broad market. By September 2022, amid global economic uncertainties and local inflation concerns, COSCO's share price hit an all-time low of 3.80 pesos. In September 28, 2022, low marked the nadir of a multi-year downtrend. It was the cheapest price in COSCO's listed history, reflecting investor pessimism at the time. Contributing factors likely included pandemic-related earnings pressures, particularly in 2020 and 2021, rising inflation, which can hurt consumer stocks, and a general market sell-off in 2022. It's worth noting that 3.80 pesos was extremely low relative to fundamentals, equating to a price-to-earnings ratio in the low single digits. Savvy investors who bought at those distressed levels were essentially purchasing COSCO at a historic bargain. Since late 2022, COSCO's stock has staged an impressive recovery. As the company's earnings improved and market sentiment shifted, the share price roughly doubled from its lows. By early 2024, the stock had climbed back to the 5 to 6 pesos range, and it continued rising through 2024 alongside COSCO's strong profit growth. Over the course of 2023, COSCO's stock rose about 35 to 40%, reflecting renewed investor confidence as the Philippine economy rebounded and COSCO reported record income. The uptrend accelerated in the first half of 2025, aided by share buyback activity by the company, which can boost the stock price by reducing supply and generally bullish sentiment for consumer stocks. By late 2025, COSCO's shares reached around 7.90 pesos at their 52-week high. As of January 2026, the stock is trading in the vicinity of 7.50 pesos per share. This price represents around 46% increase from 5 years ago and an even larger gain of roughly up 100% from the 2022 bottom. In comparison to the broader Philippine stock index, COSCO has outperformed in the last 1 to 2 years, thanks to its earnings surge and proactive capital returns. However, looking at a longer horizon, COSCO's stock is still well below its peak values from a decade ago. The all-time high was 18.10 pesos back in May 2013, reached during a bull market when many Philippine consumer stocks traded at rich valuations. The current price, around 7 to 8 pesos, is less than half of that 2013 high, indicating that COSCO's market valuation has compressed substantially over the years. Part of this decline can be attributed to a general market re-rating. Investors now apply lower price multiples to holding firms, and the fact that COSCO paid out special dividends and underwent some structural changes, like spinning off the keepers via a backdoor listing in 2021. The stock's journey from 18 pesos in 2013 down to 3.80 pesos in 2022 and back up to around 7.50 pesos in 2026 shows the ups and downs of market sentiment. Periods of enthusiasm, 2013, gave way to years of sideways or declining prices, despite the company's profits growing in the background, and then a sharp correction and recovery around the pandemic. Analyzing the 5-year trend, 2021 to 2025, specifically, COSCO's share price was relatively flat to mildly down in the late 2018 to 2019 period, trading roughly between 5 pesos and 6 pesos. In early 2020, it likely dipped with the COVID market crash, but bounced back as Pure Gold's grocery business proved defensive. The real weakness came in 2021 to 2022, when inflation and interest rate worries, plus perhaps the technical impact of the Keeper spin-off, dragged the stock to multi-year lows. By early 2022, COSCO was around 4 to 5 pesos, then slid to 3.80 pesos by Q3 2022. From that point onward, it entered a recovery phase. 2023 saw a strong rally. The stock gained around 40% over the year, and 2024 continued that positive momentum. The trading volume and liquidity improved as well, partly due to company buybacks and increased investor interest. Notably, COSCO's stock has a low beta of 0.46 over 5 years, meaning it's historically less volatile than the market. But during 2022 to 2025, its moves have been significant, driven by valuation mean reversion. As of now, 2026, COSCO's stock is on a firm upward trend, having more than recovered the ground lost during the pandemic. A 1-year change of about plus 40% is observed at current prices, which is a testament to how the market has started to recognize COSCO's improved earnings. Yet, the stock's valuation remains relatively subdued versus its history, still far from that 2013 high. This suggests that while price has risen, there may still be substantial upside if valuation multiples expand. The recent rise has been supported by tangible factors, a series of strong financial results, and the company's active share repurchase program. The latter is important. COSCO instituted a buyback program in 2024, purchasing shares almost daily for months. Such buybacks provide support to the share price and signal management's confidence that the stock is undervalued. In summary, COSCO Capital's stock over the last 5 years went from stagnation to collapse and then to recovery. Investors who endured the weak 2018 to 2021 period saw the stock go nowhere or down, but those who accumulated near the 2022 lows have seen their position roughly double by 2025. The 5-year return of plus 46% as of January 2026, while respectable, comes with the caveat that most of those gains occurred in the last 2 years. It underlines how market sentiment can lag fundamentals. COSCO's earnings were growing even when its stock languished around 4 pesos. Now that sentiment has improved, the stock is playing catch-up to the company's intrinsic value. Going forward, key questions will be whether this momentum continues and if COSCO's stock can challenge new highs as it closes the valuation gap. For now, the trend is positive, with the stock trading near the upper end of its recent range, 52-week high around 7.90 pesos, and technical indicators largely bullish, daily technical signal rated strong buy in January 2026. Investors should remain mindful, however, that past volatility could recur, and external factors, economic shifts, market-wide moves, will influence COSCO's share performance alongside company-specific results. From a fundamental standpoint, COSCO Capital exhibits a sound financial profile characterized by steady earnings, healthy margins for its industry, and a conservative balance sheet. Let's break down a few key aspects. Profitability. COSCO's profitability metrics are solid given the nature of its businesses. The company's net profit margin is about 3.8% in recent periods. This means that for every peso of revenue, COSCO earns roughly 3.8 centavos in net profit. While that margin may appear thin, it is typical for the grocery retail sector, which operates on high volumes and low margins. Importantly, COSCO's net margin has been consistent in the around 3 to 4% range over the years, indicating effective cost control and pricing strategies even amid fluctuating costs. On the gross margin level, COSCO posts around 19% gross margin, reflecting the markup on products after cost of goods. This figure again is in line with large-scale retail. Supermarkets often have 15 to 20% gross margins, and is aided by higher margins in the liquor distribution segment, which offset the ultra-thin margins of certain grocery items. The operating margin is about 8%, showing that after selling, general and administrative expenses, COSCO retains a mid-single-digit percentage of sales as operating profit. This is a respectable operating efficiency for a diversified retailer. Return on equity, ROE, stand around 10 to 10.5% in recent years. An ROE of around 10% indicates COSCO generates a 10-cent return on each peso of shareholders' equity per year. This level of ROE is decent and roughly comparable to or slightly lower than the broader market average. It's not a spectacularly high ROE. Some pure retail peers with higher leverage might have ROEs in the mid-teens, but COSCO's moderate ROE must be viewed in context of its very low debt use. Essentially, COSCO achieves around 10% ROE with minimal financial gearing, which implies strong operational performance. Additionally, COSCO's return on assets, ROA, is around 5.4%, and return on invested capital, ROIC, about 11%, further underscoring that the company earns an adequate return on the capital it deploys in the business. Efficiency and growth. COSCO has been growing its revenues at around 8 to 9% annually, pre-2024, and managed to grow earnings faster than sales in certain years due to margin improvements. For example, over the past year, earnings grew around 21.5% for year 2024 versus prior year, outpacing revenue growth, highlighting improving efficiency. The company's asset turnover, revenues to assets, is about 1.06 times, meaning it generates just over 1 peso of revenue for every peso of assets each year. A reasonable ratio for a retail-oriented firm that holds significant inventory and fixed assets. Inventory turnover is around 5.1 times, indicating inventory is cycled through about 5 times a year, which is typical for grocery retail, where goods move quickly. These figures suggest COSCO manages its operations effectively to avoid capital being tied up unnecessarily in stock or assets. On the cost management front, COSCO has faced rising input costs, commodity prices, wages, utilities, but has generally mitigated these via economies of scale and supplier negotiations. One challenge was in 2022 when high electricity prices increased operating costs for malls and properties, causing a profit dip in the real estate segment. Even so, the impact on the group was limited, thanks to cost savings elsewhere and strong sales to absorb overhead. COSCO's effective tax rate is around 20%, close to the statutory corporate tax rate after accounting for tax incentives in some businesses, like real estate investments, so no red flags there. Financial health, balance sheet, a standout aspect of COSCO Capital is its conservative balance sheet and low debt levels. As of the latest data, the company's debt-to-equity ratio is only around 0.38, or about 38%. This indicates that COSCO's total interest-bearing debt is just 38% of its equity, a relatively low leverage ratio. In fact, in absolute terms, COSCO has 60.65 billion pesos in debt versus 159.4 billion pesos in equity. Moreover, the company holds 64.9 billion pesos in cash and equivalents. This means COSCO is in a net cash position of about 4.23 billion pesos, cash minus debt. Being net cash positive is a significant strength. It implies that the company's liquidity can cover all its debts with money to spare. In practical terms, COSCO could pay off every peso of debt using its cash on hand, which is a rare and very healthy situation for a large company. This affords COSCO financial flexibility to invest in expansion or weather downturns without solvency concerns. To further gauge solvency, COSCO's current ratio is approximately 3.78, meaning current assets, cash, inventory, receivables, are almost 4 times current liabilities. This high current ratio reflects abundant liquidity, largely due to cash and inventories, ensuring the company can meet short-term obligations easily. The interest coverage ratio is over 5.7 times, indicating that COSCO's earnings before interest and taxes can cover its annual interest expense about 5.7 times. An interest coverage well above 3 times is usually considered safe. COSCO's 5.7 times, paired with its minimal net debt, signals very low financial risk. Essentially, debt is a minor part of COSCO's capital structure, and the company is not burdened by interest costs, which were $710 million in 2024 per financials, easily covered by operating profit. This conservative approach likely stems from management's prudent capital management and strong cash flow generation from operations. Dividend policy. COSCO Capital has been a consistent dividend payer. It typically pays cash dividends to shareholders annually and occasionally interim dividends. The dividend payout ratio currently stands around 43% of earnings, which means less than half of net profits are distributed as dividends, leaving the majority for reinvestment or buybacks. In peso terms, the latest annual dividend was 53 cents per share, translating to a dividend yield of roughly 7.1% at recent prices. Even using a more conservative figure, the dividend yield is in the 5 to 6% range, which is quite attractive and well above the market average yield of around 2.8%. This indicates COSCO is sharing profits generously with shareholders. The dividends have grown irregularly, with occasional special dividends, but on average the company has maintained or increased its payout over time. For example, a 5-year dividend growth rate of around 27% was noted, though not a smooth trend. Importantly, the dividends appear well covered by earnings and cash flow. With a sub-50% payout, COSCO retains ample earnings, and its free cash flow, 22 billion pesos last year, far exceeds the cash needed for dividends, around 3.7 billion pesos if 53 cents per share on 7 billion shares. Therefore, the dividend is sustainable and safe by conventional measures. For investors, this means an investment in COSCO not only offers potential price appreciation, but also a steady income stream. In summary, COSCO Capital's fundamentals are robust. The company is profitable with stable margins. Its returns on equity and assets are reasonable for a conglomerate focused on retail, and it operates with very low leverage. It has abundant liquidity and generates more cash than its accounting profits, a sign of quality earnings. These factors together give COSCO a strong foundation. If one were to identify weaknesses, it might be that net margins are inherently low due to industry, not mismanagement, and growth, while steady, has not been explosive, single-digit revenue growth in a normal year. But these are common traits in mature retail businesses. Overall, Costco's financial health can be characterized as conservatively managed and efficient. It doesn't take on big debts or risky ventures. It steadily grows sales, keeps costs under control, and returns value to shareholders through dividends and buybacks. This fundamental strength underpins the stock's investment thesis and provides confidence that Costco can withstand economic fluctuations and competition pressures moving forward. In the Philippine stock market, COSCO Capital stands out as a diversified retail holding firm, and comparing it to peers requires looking at both operational peers, companies in similar businesses, and structural peers, holding companies with similar traits. Let's examine how Costco measures up against retail sector peers. Costco's nearest operational peers are companies in the grocery and retail space, such as Pure Gold Price Club, Robinsons Retail Holdings, Philippine 7 Corp., the local 7-Eleven franchisor, and other consumer retailers. It's important to note that Pure Gold itself is a part of Costco. Costco owns around 49% of Pure Gold. So in a sense, Costco and Pure Gold are intertwined rather than independent competitors. However, from an investor's perspective, one could invest in Pure Gold directly, a pure grocery play, or in Costco, which holds Pure Gold plus other assets. When comparing valuation multiples, Costco appears significantly undervalued relative to most peers. Costco stock currently trades at a price-to-earnings P/E ratio of about 5.2 times, trailing basis. This is exceedingly low. For context, Pure Gold's P/E is around 10 times, mid-2025, and Robinsons Retail, which owns supermarkets, department stores, drugstores, etc., has a P/E roughly between 6 times and 9 times depending on earnings timing. The industry average P/E for consumer retail in Asia is around 16 times, so Costco's 5 times is a deep discount. Even 7-Eleven trades higher. Its market cap, around 54.7 billion pesos, is similar to Costco's, but its P/E would be higher given its growth status. In terms of price-to-book ratio, PB, Costco is around 0.33 times book value. This means the market price is only one-third of Costco's book value per share. Book value is around 14.77 pesos. Stock at 7.5 pesos. Pure Gold, by contrast, trades near 1.1 times book, and Robinsons Retail around 0.5 times to 1.2 times book, depending on market swing. Essentially, Costco is valued at a significant discount to the sum of its parts and assets. This undervaluation is partly explained by Costco's holding company nature. Investors often apply a holding company discount because a conglomerate's value can be less accessible, cash flows come from subsidiaries, and because of potential overhead or complexity. In Costco's case, its market capitalization, around 52 billion pesos, is intriguing when broken down. Costco's stake in Pure Gold alone, at current Pure Gold share prices, is worth on the order of 40 to 50 billion. Its majority stake in the Keepers adds more. Keepers' market cap is around 34.8 billion. Costco owns around 78%, so roughly 27 billion worth. Summing those, the market essentially implies that the entire real estate portfolio and office warehouse, plus any other assets, are being valued at near zero or negative value, or that the whole is less than the parts. This is a classic conglomerate discount scenario. Investors looking for pure exposure might indeed just buy Pure Gold stock or the Keeper stock individually. That behavior can leave a holding firm like Costco trading at a perpetual discount despite its assets' true worth. However, for a value investor, this discount is an opportunity, as Costco's price-to-sales ratio is only 0.20 times, 20 cents a market cap per 1 peso of sales, which is extremely low for a profitable company. By comparison, Pure Gold's price-to-sales ratio is about 0.5 times, and Robinsons Retail's around 0.4 to 0.6 times. Costco's price-to-cash flow ratios are also strikingly low, around 2.3 times. This means at the current stock price, the company's free cash flow yield is over 40%, an indicator of potential undervaluation. Such metrics suggest COSCO is priced like a bargain or value trap, whereas peers trade closer to what one might consider fair value. Simply put, COSCO stock is cheap relative to peers on almost every metric: price to earnings, price to book, price to sales, and dividend yield. Looking at dividend yield, COSCO's around 5 to 7% yield comfortably beats many peers. Pure Gold's dividend yield is often below 5%, as it retained earnings for growth, and Robinsons Retail's yield is around 5 to 6%. The high yield again reflects COSCO's low price and generous payout. So on an income basis, COSCO might appeal more to dividend-focused investors than its peers do. In terms of business performance and strategy, COSCO's portfolio has some differences from peers. Robinsons Retail, for example, is another major retail group, but with a broader mix, including drugstores, Southstar Drug, department stores, convenience stores, and DIY stores, whereas COSCO sticks to food retail and liquor primarily. Robinsons Retail's earnings growth has been moderate, and it also trades at low multiples. Its PE dropped to around 6 to 8 times after a large one-time gain and a stake sale by an insider, causing market flux. This shows that the Philippine retail sector as a whole has been trading at depressed valuations recently, possibly due to economic concerns and razor-thin margins under high inflation. Even so, COSCO is at the low end of the valuation spectrum. Another peer, Philippine 7, has a market cap similar to COSCO, around 50+ billion, and operates convenience stores. 7-Eleven is more of a growth stock and likely carries a higher PE, 10 times or above. COSCO, by contrast, offers exposure to large format retail, which is more mature but very cash generative. Versus other holding companies, it's also useful to compare COSCO to other listed holding companies or conglomerates in the Philippines, though their sectors differ. Many conglomerates, such as GT Capital, LT Group, Philinvest, etc., trade at discounts to NAV, net asset value. COSCO's around 0.3 times PB is in line with or steeper than some. For instance, LT Group, Lucio Tan's conglomerate with tobacco, alcohol, banking, has traded around 0.5 times book with a high dividend yield, and GT Capital, Thai Family, with banking, auto, property, around 0.7 times. COSCO's discount seems larger, potentially because it is smaller and less liquid, fewer institutions own it. Insider ownership is about 68%, the co-family and affiliates, leaving a public float of only around 21 to 22%. This relatively low float can reduce trading activity and deter some big investors, contributing to a lower valuation. In comparison, Pure Gold's float is larger. The co-family shares some ownership via COSCO and some directly, but Pure Gold has more public ownership in its count. Robinsons Retail is majority owned by the Gokongwei family, but still has significant public ownership and more analyst coverage. From a market position perspective, COSCO's retail businesses are quite competitive. Pure Gold is the second largest grocery chain in the Philippines, after SM Markets of SM Group, and SNR is a unique player with little direct competition historically, until recently. More on that under risks. Robinsons Supermarket, under RRHI, competes with Pure Gold in some areas, but Pure Gold tend to focus on a slightly different segment, including the sari-sari store wholesalers and value-conscious consumers, whereas Robinsons caters to mid-market mall-goers. In liquor, COSCO, the Keepers, essentially has no listed peer. Its competition are local manufacturers like Imperador, which is a liquor producer, not importer, and smaller importers. The Keeper's near monopoly on imported spirits distribution gives COSCO a dominant niche that peers don't have. This could arguably warrant a premium, yet the stock doesn't reflect that, likely because the value of Keepers is hidden inside COSCO, and Keepers itself trades at moderate multiples, around 10 times P, after a recent rally. If we compare COSCO to Imperador Incorporated, Imperador trades around 18 times PE and 2 times book, showing how richly a pure liquor company can be valued versus COSCO's integrated model. One can also compare growth prospects. Pure Gold's growth has matured to single digits. Robinson's Retail's growth is mid-single digit, whereas Costco's liquor business has been growing double-digit. Mary Mart and All Day are smaller grocery upstarts with high growth plans, but currently much smaller scale, and high PEs that have come down after initial hype. Costco, being established, isn't priced for high growth, it's priced for value. In a peer context, Costco might be seen as the value play in Philippine retail, whereas something like Mary Mart was the growth play, though that bubble has tempered. In summary, COSCO Capital is undervalued relative to peers by multiple measures. Its P, around 5 times, is roughly half that of Pure Gold, around 10 times, and lower than Robinson's Retail, around 7 to 9 times. Its PB, around 0.3 times, is far below Pure Gold's 1.1 times, or even Robinson's 0.5 to 1.2 times. It offers a significantly higher dividend yield than most consumer stocks. These discounts likely reflect a conglomerate structure discount and lower market liquidity, not inferior business fundamentals. In fact, operationally, Costco's assets perform on par with or better than competitors. Pure Gold is a market leader in grocery. SNR is unique, and the Keepers outperforms any peer in imported liquor. The trade-off for investor is whether they want a focused investment, like just Pure Gold, or the broader but undervalued basket Costco. If one believes the market will eventually recognize Costco's full value through either narrowing the holding company discount or through corporate actions like more buybacks or spin-offs, then Costco at these multiples could be considered cheap. Conversely, the persistent discount indicates that, relative to peers, Costco stock may remain lagging until a catalyst emerges. To visualize, consider that as of January 2026, Costco's market cap is about 52.9 billion pesos. Pure Gold's is roughly around 90 billion, and Robinson's Retail's around 60 billion, approximate, as of late 2025. Costco, thus, is smaller than Pure Gold in market value despite containing half of Pure Gold plus other businesses, and nearly the same size as Robinson's Retail, which is similar net income. This disparity underlines how Costco is a compelling value relative to the Philippine retail sector, albeit one that the market has been slow to fully appreciate. For investors considering COSCO Capital, several compelling reasons to buy emerge based on its fundamentals and market position, undervaluation, and upside potential. Perhaps the strongest reason is that Costco appears significantly undervalued relative to its intrinsic value. The stock is trading at very low valuation ratios, around 5 times earnings and 0.3 times book value, which is exceedingly cheap for a consistently profitable firm. One analysis estimates that Costco's share price is over 80% below its fair value in terms of intrinsic worth. This implies a large margin of safety and potential upside if the market re-rates the stock upward. In practical terms, simply closing the gap to a normal PE, say 10 times like Pure Gold, could roughly double Costco's share price. Additionally, Costco's sum of the parts valuation, Pure Gold plus SNR plus Keepers plus properties, comfortably exceeds its current market cap, an indicator that the parts are worth more than the whole at present. Investors bullish on Costco believe that eventually this gap will narrow, delivering gains. It's worth noting that as of now, even sell-side analysts see upside. The sole analyst price target is 13.20 pesos, about 75% above the current price. This undervaluation, combined with improving earnings, presents a value investment case for buying Costco. Strong market positions and brand portfolio. COSCO Capital owns market-leading businesses in their respective niches. Pure Gold and SNR are household names in Philippine retail. Pure Gold is one of the largest supermarket chains catering to millions of consumers, and SNR is a premier membership club with a loyal following. These brands give Costco a strong competitive moat. The company's liquor segment, via the Keepers, holds a dominant 74% market share in imported spirits distribution. Such market dominance often translates to pricing power and high barriers to entry. Investors looking to tap into the stable cash flows of defensive sectors, food retail, and staple beverages. Get that with COSCO. The retail businesses tend to be resilient even in economic downturns. People still buy food and basic goods, which provides a defensive characteristic to COSCO's earnings. Owning COSCO stock is effectively owning a slice of some of the Philippines' top consumer companies, Pure Gold, SNR, etc., bundled together. These strong market positions suggest COSCO's core businesses can continue to generate steady revenue and profit, underpinning a long-term buy-and-hold thesis. Consistent earnings and growth track record. COSCO has demonstrated consistent profitability and respectable growth. It navigated the pandemic without losses, and earnings have generally trended upward. 2022 net income up 17%, 2024 up 25%, as noted. Over the past decade, despite economic cycles, COSCO continued to expand its store footprint and improve its top and bottom lines. This track record gives confidence that management can deliver results. Importantly, COSCO's earnings are diversified across multiple segments, which adds stability. All its business units contributed to the 2024 earnings surge, showing broad-based strength. For investors, steady growth in earnings often leads to stock appreciation and growing dividends. If one expects the Philippine economy and consumer spending to keep growing in the coming years, which is likely given favorable demographics and GDP growth, COSCO is a direct beneficiary. The company itself noted optimism in continued top-line growth due to healthy economic fundamentals and underserved demand in retail. Thus, buying COSCO is a play on the ongoing growth of the Philippine consumer market, with a company that has shown it can capitalize on that growth. Financial strength and low risk profile. COSCO's strong balance sheet and cash generation reduce the investment risk. The company has virtually no net debt and ample cash, which means the chance of financial distress is minimal. This is a comforting factor for long-term investors. One can buy and not worry about solvency or onerous interest burdens eating into profits. The solid interest coverage and liquidity also mean COSCO can finance expansion internally or through low-cost borrowing if needed. Additionally, COSCO's management has taken shareholder-friendly actions like share buybacks. In 2024, the company engaged in a sustained share repurchase program, which not only signals confidence that the stock is undervalued, but also directly improves metrics like EPS by reducing outstanding shares. These buybacks likely contributed to the stock's rise and indicate that management is actively working to enhance shareholder value. For a potential investor, it's encouraging to see the company put money where its mouth is by buying its own shares, a strong buy signal. Furthermore, COSCO's dividend yield of 5 to 7% provides an immediate return on investment while one waits for price appreciation. This relatively high yield, backed by stable earnings, makes COSCO attractive to income investors as well. You are essentially paid to wait, collecting generous dividends, which is a compelling reason to buy at current prices. Macro and sector tailwinds. The broader environment also offers reasons to be bullish on COSCO. The Philippine economy is forecast to continue growing at a healthy rate, and consumer spending is a major driver of GDP. COSCO's businesses, groceries, beverages, etc., are aligned with fundamental consumer needs, meaning they stand to benefit from population growth, rising disposable incomes, and urbanization in the Philippines. Even in the face of recent inflation, consumption has been fairly robust, bolstered by factors like OFW remittances and wage increases. As inflation moderates, assuming it will, companies like COSCO could see input cost relief while demand remains strong, expanding margins. Additionally, COSCO has opportunities for expansion. There are still areas in the Philippines underserved by modern retail, and COSCO can continue to open Pure Gold and SNR stores in those locales. The company is indeed expanding. Pure Gold's store count keeps rising. It has opened dozens of new stores annually in recent years, and SNR has been slowly adding warehouses. COSCO's venture into new formats, like possibly the home improvement tie-up with Siam Global or more Pure Gold extra smaller stores, suggests growth avenues beyond current core operations. All these represent future growth catalysts. For investors, Buying Costco now offers exposure to this future growth at a valuation that doesn't seem to price it in. Diversification and resilience. By purchasing Costco, investors get a built-in diversification across multiple segments of retail. This can be seen as a plus. For example, if one segment faces a temporary slowdown, others may compensate. Costco has both consumer staples, food, and consumer discretionary, liquor, specialty elements. During economic booms, discretionary spending rises, benefiting S&R and liquor sales. And during downturns, staples hold up, Pure Gold's groceries remain in demand. This balance can make Costco a relatively resilient investment across economic cycles, which is a reason to favor it over a single segment peer. In summary, reasons to consider buying COSCO Capital stock include its deep value pricing, high dividend yield, and significant upside potential as the market corrects its valuation. The company's dominant market positions and brand strength, with Pure Gold, S&R, and Alfonso Brandy, ensure it will continue to capture consumer spending. Its financial stability, ongoing share buybacks, and shareholder returns reflect a shareholder-friendly approach and low-risk profile. And finally, the macroeconomic backdrop of a growing consumer economy provides a tailwind. All these factors make a strong case for a buy rating on Costco, particularly for investors with a medium to long-term horizon who can wait for the market to realize the company's full value. For investors who already own COSCO Capital or those adopting a more cautious stance, there are good arguments for holding the stock, neither aggressively buying more nor selling, but continuing to own it. Here are key reasons to hold. Stable fundamentals justify holding. Costco's underlying business is fundamentally sound, and holding the stock allows investors to continue benefiting from its steady performance. If you have held Costco through its recent rally, the stock rose around 40% in the past year. You have likely seen substantial gains. Even after this appreciation, the stock remains supported by solid earnings and cash flows. There is no sign of deterioration in the company's core operations. Supermarkets are still expanding, liquor sales are strong, and rental income is steady. All segments are profitable and contributed positively in the most recent year. Thus, there is a strong case to simply hold on to shares and let the investment thesis continue play out. Costco is not overvalued or in a bubble that would urge profit-taking. On the contrary, many would argue it's still undervalued. So, existing investors can justify holding as the stock still has room to reach a more fair valuation. Meanwhile, as a holder, you continue to collect dividends, yield around 6%, which reward your patience. Income and dividends hold for the yield. Costco has established a pattern of generous dividends. A holder of Costco stock gets a significantly better yield than most alternatives in the Philippine market. If one strategy is income-oriented, holding Costco for the long term makes sense to keep receiving those cash dividends. The dividend payout is well supported by earnings, payout ratio around 43%, making it likely that Costco will sustain or even raise its dividends over time. As an example, in 2025, Costco declared total dividends that gave about a 7% yield at the low prices, an attractive return just for holding the stock. Even as the share price has risen, the yield is around 5 to 6%, which is still high by market standards. Therefore, if you bought Costco at lower levels, holding on to it provides a steady income stream that might be hard to replace elsewhere without increasing risk. Further upside with lower risk. From a risk-reward perspective, Costco's risk profile remains relatively low, debt-free, defensive businesses, while upside catalysts are still on the horizon. If you already have profits in Costco, you might hold rather than sell because the story isn't over. The market has begun to re-rate Costco, but as discussed, full valuation is not yet achieved. It's still only around 5 times PE, where peers or intrinsic value might warrant closer to 10 times or more. Holding the stock longer could allow you to capture that remaining upside without taking on substantially new risk, since your initial cost basis may be low and you're essentially riding on house money to an extent. Additionally, Costco's management actions, like the ongoing share buyback program in 2024, indicate that they may continue to support the share price. The company repurchased shares consistently, signaling confidence and possibly providing a floor for the stock. An investor who already owns Costco might want to hold to benefit from these company actions and any future strategic moves, such as potential spin-offs, acquisitions, or further buybacks. Lack of better alternatives and diversification. For those who want exposure to the Philippine consumer sector, holding Costco might remain one of the better choices. Pure Gold and Robinsons Retail, while solid companies, offer either lower dividend yields or less diversification. If you hold Costco, you inherently have a more diversified stake, grocery plus liquor plus property. Replacing them by selling Costco and buying separate stocks could increase complexity or risk. Some investors might hold Costco simply because it's a convenient one-stop exposure to multiple consumer businesses. Moreover, Costco's liquidity is improving, average volumes up as price rose, making it easier to hold even for larger investors. If one is not in urgent need of cash or does not see a clearly superior investment opportunity, the rational decision can be to hold onto a good asset like Costco. Wait and see amid market uncertainty. Another reason to hold, instead of buying more or selling, is if an investor is adopting a wait-and-see approach regarding certain developments. For instance, there are some uncertainties on the horizon. The broader economic environment, interest rates, inflation, and competitive moves, like new entrants to S&R space. Rather than sell out, which might be premature given Costco's strength, or buy more, which might be aggressive if one expects a temporary headwind. An investor might hold their position and monitor how these factors play out. Costco's recent earnings growth was stellar, but as we enter a more normalized post-pandemic environment, growth may moderate. Indeed, in the first 9 months of 2025, profit growth slowed to 6.6%. An investor could hold through this phase, confident in the long term, but cautious in the short term. Holding lets you stay invested to capture long-term appreciation without increasing exposure at a possibly slower growth juncture. Essentially, if you believe in Costco's long-term value but are mindful of short-term volatility, holding is a prudent middle ground. Tax and cost considerations. For some long-term holders, practical considerations like avoiding capital gains tax for those subject to it or trading costs may encourage holding rather than selling. If you bought Costco at a much lower price, selling could trigger taxes on gains and you might lose a low entry point. By holding, you defer any taxable event and continue compounding your returns through price appreciation and dividends. In conclusion, hold makes sense for COSCO Capital if you're satisfied with its current performance and see more gradual upside ahead, but prefer not to increase your position. Costco's investment fundamentals remain intact and supportive of holding. It's financially healthy, pays substantial dividends, and still has upside potential, albeit with perhaps less explosive growth than a year ago. There are no glaring red flags that would necessitate an exit. On the contrary, most signs, continued earnings, buybacks, undervaluation, point toward remaining invested. Holding allows investors to remain part of Costco's ongoing story, benefiting from any further market recognition of its value, while mitigating the risk of making a wrong timing decision by selling too early or chasing something else. Given Costco's stable and defensive characteristics, many investors may find comfort in simply holding their shares as a long-term core position. While COSCO Capital has many strengths, investors should also consider potential reasons to sell or reduce their position. Selling might be rational under certain scenarios or viewpoints. Slowing growth and post-rebound plateau. One reason to consider selling is the observation that Costco's earnings growth may slow down after the post-pandemic rebound. The exceptional profit surge of 2022 to 2024, especially the up 25% jump in 2024, is unlikely to repeat every year. Recent reports indicate that by 2025, Costco's growth normalized. For the first 9 months of 2025, net income grew only 6.6%, a much slower pace than the previous year's nearly 10% at the same stage. This deceleration was attributed to softer consumer spending and a more tempered retail environment as the post-pandemic surge subsided. If an investor's thesis was heavily based on rapid growth, that thesis is now changing. With profit growth reverting to single digits, the stock's quick appreciation might stall. So, one might sell or trim their position if they believe the easy gains from earnings normalization have been realized and future growth, and thus upside, will be much more incremental. Essentially, if COSCO's earnings plateau around 15 billion pesos and only grow modestly forward, the market might not assign it a much higher valuation in the near term, especially if interest rates are high, which compress PE multiples. Thus, an investor could take profits now in anticipation of potential range-bound stock performance once the reopening boost fades. Competition and market changes. Another concern is increasing competition in COSCO's key businesses, which could be a reason to reduce exposure. For instance, in the warehouse club segment, new competition is emerging. The Ayala Group, one of the Philippines' largest conglomerates, has partnered with a foreign firm to resurrect the Macro brand, warehouse membership stores, to challenge SNR. This is a notable development. SNR has long enjoyed a unique position with little direct competitor on a national scale. A well-funded entrant like Ayala could slowly erode SNR's market share or force it to innovate and spend more. In groceries, competition from existing players, SM Supermarkets, Robinsons, newcomers like All Day, Marimart, means the space remains price competitive, possibly pressuring margins. In liquor distribution, while COSCO dominates imports, shifts in consumer preferences or aggressive moves by competitors, like if local distillers like Imperador push harder into imported categories or new brands bypass the keepers, could pose a risk. Furthermore, regulatory risks such as higher sin taxes on alcohol could dampen liquor demand or margins, something that is always a possibility as the government periodically raises taxes on alcoholic beverages. If an investor believes that COSCO's best days of easy market dominance are behind it and that competition will intensify, which might require higher capital expenditure, marketing spend, or result in lost sales, they might choose to sell before these pressures potentially reflect in the financials. Persistent holding company discount. We discussed undervaluation as a reason to buy, but the flip side is that COSCO's conglomerate discount may persist indefinitely. Some holding companies trade at a discount for a very long time due to structural reasons, such as complex structure, low transparency, or simply investor preference for pure plays. If one grows impatient with the market's slow recognition of COSCO's value, one might sell and invest elsewhere. Indeed, COSCO traded at low multiples for years and only recently saw its price improve. There's no guarantee it will reach what we consider fair value soon. If the stock, for example, stays around 7 to 8 pesos for a long period, investors might find better opportunities with their capital. Additionally, liquidity constraints, with only around 22% public float, mean large institutional investors may continue to avoid COSCO, which could cap its upside. As a result, the stock might always be somewhat undervalued relative to fundamentals. Investors who are frustrated by this, or who prefer more liquid, widely covered stocks, might decide to exit COSCO despite its business strength, reallocating funds to a company where the valuation gap could close faster. Portfolio rebalancing and overexposure. If COSCO's stock has appreciated significantly in one's portfolio, it's up around 100% from 2022 lows, an investor might sell some shares to rebalance and lock in profits. This isn't a knock on COSCO per se, but a risk management practice. Overexposure to a single stock or sector, in this case, Philippine retail, can be risky. If COSCO now constitutes an outsized portion of one's holdings, trimming the position can reduce risk. Also, if one bought COSCO primarily at very low prices, at around 4 or 5 pesos, with the intention to sell a certain price target, reaching near 7 to 8 pesos might hit their take-profit level. Their original investment thesis, value gap closing, might be largely fulfilled by the rally. Without an updated thesis, selling to secure gains is reasonable. Macroeconomic concerns. Broader macro factors could also be a reason to sell or lighten up. If an investor expects an economic downturn or recession in the Philippines or globally, they might preemptively reduce holdings in consumer-oriented stocks like COSCO. High inflation in 2022 to 2023 put pressure on retailers' margins. If inflation were to surge again or interest rates remain elevated, consumer spending power could decline and financing costs for expansion rise. There are early signs by late 2025 of consumer spending slightly softening as pent-up demand normalizes. Additionally, the Philippine peso's value and global commodity prices can affect import costs, particularly for the liquor segment that imports products. If one anticipates unfavorable macro trends, e.g., weaker remittances, higher unemployment, or currency depreciation, they might expect COSCO's future earnings to underperform current expectations. Under such a scenario, taking profits now could be prudent. In essence, if the risk of macro headwinds outweighs the remaining upside, selling becomes a defensible move. Opportunity cost, better investments elsewhere. Another reason might simply be finding a more compelling investment. The stock market is relative. Perhaps another stock or asset now presents a better risk-reward profile than COSCO. For instance, if COSCO has doubled and is no longer as dirt cheap as before, even though still cheap, just less so, an investor might rotate into another undervalued stock with similarly strong fundamentals. Or if one wants to shift exposure, say, from consumer to tech or to fixed income due to interest rate changes, they might sell COSCO to free up capital. It's not that COSCO becomes a bad company, but the opportunity cost of keeping money in it could rise if other sectors take the lead in performance. In summary, reasons to sell COSCO Capital could revolve around diminishing growth momentum. The post-pandemic earnings jump is largely behind us, with growth normalizing, heightened competition that could challenge its dominance, such as Ayala's macro reentry against SNR, and the concern that the stock's valuation discount may not fully close. Taking profits after a substantial rally, especially if one's investment goals have been met, is a sensible strategy. Additionally, any negative shifts, whether company-specific, like margin pressures from costs, or external, like consumer spending dips, might warrant a reevaluation of holding the stock. Every investor's situation is different. Those with shorter horizons or more sensitivity to the factors above may lean towards selling or trimming, even as long-term fundamentals remain sound. It's all about weighing the remaining upside against the potential risks. If for a particular investor that balance no longer justifies holding, then reducing or exiting the position is the logical step. Valuing COSCO Capital and determining a prudent buy-below price involves estimating its intrinsic worth and then applying a margin of safety. Let's walk through this process. First, consider a fair value estimate for COSCO's stock. As discussed, one reference point is the consensus, albeit from a lone analyst, target of 13.20 pesos per share. This figure can be seen as an estimated fair price over the next 12 months, based on COSCO's fundamentals and peer comparisons. 13.20 pesos also aligns with the idea that COSCO should trade closer to 10 times earnings, since its earnings per share is around 1.43 pesos. 10 times that would be 14.3 pesos, in the same ballpark. Many value investors might independently assess COSCO's net asset value or sum of parts and arrive in the low teens per share as well. For instance, if we sum the market value of COSCO's stakes in pure gold and the keepers and add conservative values for real estate and office warehouse, we might easily get 12 to 15 pesos per COSCO share equivalent. Therefore, for the sake of analysis, let's take 13 pesos per share as a rough fair value estimate for COSCO at present. Applying a 30% margin of safety means we want to buy the stock at no more than 70% of its estimated fair value. 30% is a sizable safety cushion to account for unforeseen risks or errors in our estimate. If 13 pesos is fair value 100%, then 70% of that is 9.10 pesos, 13 by 0.70. To keep things simple and conservative, investors might round that to about 9 pesos per share as the buy-below price. In other words, at 9 pesos or lower, COSCO stock will be trading at a 30% discount to our intrinsic value estimate, providing a comfortable margin of safety. It's noteworthy that Costco is currently trading around 7.5 pesos per share, which is already below that 9 pesos buy below threshold. In fact, 7.50 pesos is roughly 57% of the 13 pesos fair value, implying an even larger margin of safety, about 43%. This suggests that at present prices, Costco offers more than a 30% margin of safety, part of why it's been flagged as undervalued. However, markets change and prices can rise. If Costco's stock were to climb closer to fair value, say into the 11 to 12 pesos range, new investors might hesitate to buy without a safety margin. Thus, 9 pesos serves as a useful benchmark. Below 9 pesos, the stock is in an attractive accumulation zone for value-focused investors. Above 9 pesos, but below 13 pesos, it might be a hold or cautious buy depending on one's required margin of safety. Why 9 pesos specifically? At 9 pesos, Costco's PE would be around 6.3 times, assuming around 1.43 earnings per share, which still builds in a safety cushion relative to peers in history. 9 pesos is also below the stock's recent high, so not buying at the top. And importantly, it's a price where the dividend yield would be very high, around 5.9% if dividend is 53 cents, rewarding investors as they wait for price convergence. 9 pesos is approximately the level that is 30% below the known target of 13.20 pesos, matching the margin of safety formula. Of course, valuation isn't static. If Costco's earnings grow further, our fair value estimate might rise, and so would the buy below threshold. For example, if over the next year Costco grows and one thinks fair value is 15 pesos, then 70% of that is 10.50 pesos. But based on current information and a fair value around 13 pesos, 9 pesos is the guidepost. Investors should use this buy below price as a discipline. It means one would aim to buy shares only when the market price is comfortably below intrinsic value, providing room for error. This protects against downside if things don't pan out as expected. In Costco's case, since it already trades below that level, it indicates the stock is a buy from a value standpoint right now. If the price were above 9 pesos and approaching fair value, one might hold off and wait for a better entry, for instance, during a market pullback, to maintain that margin of safety. In summary, given a fair value estimate of around 13 pesos per share for COSCO Capital, a 30% margin of safety translates to a buy below price of roughly 9 pesos per share. Value investors would consider accumulating the stock at 9 pesos or less. At those levels, one is effectively buying a peso of Costco's intrinsic value for 70 centavos or less, a favorable bargain. Always remember that the margin of safety is about being cautious. It's better to miss a bit of upside than to risk significant downside. 9 pesos provides that cushion. Given that the current market price, around 7.5 pesos, is under this threshold, Costco appears to offer a compelling opportunity. But if the price rises, employing patience to wait for around 9 pesos or lower could be prudent for those who strictly adhere to a 30% safety margin. In evaluating COSCO Capital, it's important to weigh the risk factors that could challenge its performance, as well as the opportunities that could enhance its growth and value. This balanced view helps investors understand the future trajectory and uncertainties of the company. Key risk factors: competitive and market risks. As discussed, rising competition in both grocery retail and wholesale club retail is a significant risk. New entrants like Ayala's Macro in the membership club space and aggressive expansion by existing rivals, SM Retail, Robinsons, even smaller players, could force Costco's retail subsidiaries to fight harder for market share, possibly through price reductions or higher spending on promotions. This could erode profit margins. If SNR faces direct competition in locations it operates, it might see membership renewals slow or require capital upgrades to stay attractive. Similarly, in liquor distribution, while the Keepers is dominant, competition can emerge if international brands change distribution partnerships or if large retailers attempt to import directly. Consumer preferences can shift too, such as leaning towards local craft spirits or wine, which might cut into some of the keepers' portfolio demand. Profit margin pressure. Inflation and cost increases pose an ongoing risk. We saw how in 2022 Costco's real estate profit fell partly due to higher power costs. Inflation in wages, utilities, and fuel can raise operating costs for supermarkets, electricity for store refrigeration, transport costs for goods, etc., and for property, utilities, maintenance. If Costco cannot fully pass on these costs to consumers due to competition or sensitivity of demand, its margins will tighten. The Philippines experienced elevated inflation in 2022 to 2023. If high inflation persists or recurs, Costco's expenses could rise faster than sales, squeezing profitability. Likewise, a sharp increase in excise taxes for alcohol, a policy risk, could either force price hikes that reduce volume or compress margins if Costco tries to absorb some of the tax to keep prices palatable. Economic and consumer health. Costco's fortunes are tied to the overall health of the Philippine consumer. A risk factor is a macroeconomic downturn. For instance, if overseas Filipino remittances decline or if interest rates remain very high, consumers might cut back spending. While groceries are non-discretionary to a degree, shoppers might downtrade to cheaper brands or smaller package sizes, affecting Pure Gold sales mix. SNR, being more upscale, could see membership and big-ticket sales soften if middle-class budgets tighten. We have a hint of this in late 2025, where spending was described as softer following the initial rebound. If the Philippines encounters a recession or even a significant slowdown, Costco's revenue growth could stall or reverse, since it is highly domestic consumption-focused. Regulatory and governance risks. Holding companies sometimes face regulatory scrutiny or policy changes. While Costco itself hasn't been an issue, the government could implement policies such as new retail trade laws, higher taxes, or stricter import regulations, which might affect the keeper's importation of liquor. Any such changes could increase compliance costs or reduce profitability. Corporate governance is another consideration. Costco is majority controlled by the Ko family, and minority shareholders have limited influence. There is a risk, common to family-controlled firms, that decisions could be made that favor the controlling shareholder at the expense of minorities. For example, large related party transactions, though none egregious, are evident now. Still, investors should be aware of this governance risk inherent in a 77% insider-owned company. Liquidity and market risks. Costco's stock, while more liquid than before, still has a relatively small free float. In turbulent market conditions, low-float stocks can be volatile or subject to sharp price swings, which is a risk for investors who might need to exit quickly. Additionally, if the broader stock market declines, Costco's shares could fall regardless of its fundamental performance. Market risk. We saw historically that Costco's stock can languish undervalued for long periods. There's the risk that after the recent run-up, the stock could trade sideways or even pull back, especially if some investors rotate out after capturing gains. Major opportunities. Expansion and new store openings. Costco has substantial room to grow its retail footprint. The Philippines, especially outside Metro Manila, still has many areas underserved by modern retail. Modern trade penetration is growing, but not saturated. Pure Gold can continue expanding. The chain ended 2022 with 452 stores, and by late 2025, including smaller formats, Pure Gold was approaching 500-plus stores. The Insider News mentioned 757, which may include all formats and new acquisitions. Every new store adds revenue and strengthens Pure Gold's brand presence. Similarly, SNR has opportunity to open new warehouses in provincial cities or second-tier metros where the membership model could work. These expansions drive organic growth. Costco's management has a proven track record of executing store rollouts efficiently. Pure Gold's multi-format strategy, Pure Gold Junior, Pure Gold Extra, allows it to enter different market sizes. The company's stated outlook is optimistic on continued top-line growth due to underserved demand and a relatively raw retail landscape in the country. This indicates a strong runway for opening new outlets and gaining market share. an opportunity that could propel earnings higher in coming years. E-commerce and omni-channel presence. While not heavily highlighted, there's an opportunity for Costco to leverage technology and e-commerce to boost sales. Pure Gold has been experimenting with online grocery ordering and tie-ups with apps. They have a known app called Sally, a chatbot for shopping. The pandemic accelerated Filipinos' adoption of online shopping. If Costco successfully integrates an omni-channel strategy, physical plus online, Pure Gold and SNR could capture additional revenue streams from e-commerce without heavy capital. They already have the stores as fulfillment hubs. This is an opportunity to future-proof the retail business against purely online competitors and to cater to changing consumer preferences. It can also generate richer customer data for personalized marketing. While currently online sales are likely a small fraction, any growth in this area could add to Costco's revenue at relatively low marginal cost, boosting profitability. Value unlocking moves, asset monetization, or restructuring. One big opportunity for Costco is to unlock value through strategic moves. For example, Costco could spin off or list a stake in its property portfolio as a real estate investment trust, REIT. Philippine regulations now allow REITs, and several companies have listed their property assets to realize value. Costco's 55 commercial properties generate stable rental income, which is ideal for a REIT. If Costco were to package some of these into a REIT and list it, it could unlock capital via proceeds from the IPO and surface the market value of those assets, likely higher than their book value. Similarly, Costco already spun off the Keepers by listing it in late 2021, which unlocked value and brought in capital. It could consider eventually increasing the Keepers' public float or doing something similar with SNR in the future, perhaps merging SNR with Pure Gold or listing it separately if capital needed. Mergers and acquisitions could also create opportunities. Costco might acquire complementary businesses. They bought Office Warehouse and perhaps could consolidate other small chains or suppliers. Each acquisition, if synergistic, could bolster earnings. The Coe family has shown willingness to adjust the portfolio, such as selling liquid gas for a profit, injecting liquor into a new vehicle, etc. Investors can view Costco as having hidden optionality. Management can take actions to close the holding company discount, such as more share buybacks. They executed a big one in 2024 and authorized a fund for it. If Costco announced a formal buyback program extension or a tender offer for shares, that could immediately lift the stock. In essence, corporate actions present an opportunity to unlock and realize the undervaluation. Demographic and economic tailwinds. The Philippines has a young, growing population and improving income levels over time. This macro trend is a tailwind for Costco's businesses. More people entering the middle class means more customers for SNR and higher basket sizes at Pure Gold. Urbanization means demand for organized retail increases. The country's GDP growth, often 5 to 6% annually, except pandemic, provides a favorable backdrop. Costco stands to gain from these trends organically. Rising consumer spending over the long term will naturally expand sales. If the economy does especially well, for example, low inflation, high growth scenario, Costco could see an outsized positive impact. Higher consumer confidence translates to more discretionary spending, boon for liquor and SNR, while low inflation would improve real purchasing power and possibly margins due to stable costs. In a scenario of sustained economic growth, Costco might exceed our current earnings projections, providing upside surprise. Operational efficiency and synergy. As Costco's various businesses grow, there are opportunities for improved efficiency and synergy. For instance, supply chain optimization. Costco could potentially integrate procurement between Pure Gold and SNR or leverage volume to get better deals from suppliers, especially as it grows larger. They can also cross-utilize their real estate, build new Pure Gold stores on their own land bank, saving rental costs and appreciating their property value. The company's diversification can allow best practices transfer, such as retail analytics from Pure Gold applied to Office Warehouse to improve sales per store. Such internal opportunities might not grab headlines, but can incrementally boost margins or reduce costs. leading to higher net earnings over time. In conclusion, COSCO Capital faces risks such as intensifying competition, margin pressures from inflation, and macroeconomic fluctuations, as well as the perennial holding company discount and liquidity issues. These could hinder performance or stock valuation if not managed well. On the other hand, COSCO has significant opportunities, expanding its store network into untapped markets, harnessing technology, and possibly unlocking value through strategic corporate actions. The Philippines' consumer growth story is a tide that can lift COSCO's boats. Management's actions like buybacks and savvy asset sales so far have shown they are attentive to enhancing shareholder value, which bodes well for capitalizing on opportunities. Investors should monitor how COSCO navigates the competitive landscape and capitalizes on growth avenues. If the company can mitigate the risks, for example, by differentiating its retail offerings to stay ahead of competitors and managing costs tightly, while seizing the opportunities before it, COSCO Capital could continue to reward investors in the years ahead. As always, a balanced view is key. One should be mindful of the risks discussed, but also recognize that COSCO's strengths and opportunities form a strong foundation that has allowed it to thrive for the past decade and can continue to do so. If you found this useful, please hit the like button and subscribe to Thrifty Finance Vision PH so we can make more videos like this.